Internal credit rating model, a tool for banks' credit risk management. Before I start with the topic, I would like to explain the meaning of word credit rating. The word credit means borrowing and the word rating means assigning grades. So basically credit rating means assigning grade to borrowers so as to distinguish between a good borrower and a poor borrower. A good borrower is the one who is likely to pay interest and installments on the loan taken from bank on time, and the poor borrower is the one who is likely to default. So with that note, I'll start. I have already explained the meaning of credit risk. Credit rating in technical terms means assessment of credit proposition based on certain parameters and deploying number, alphabets and symbols for that. You can see this particular diagram. D is for a low category borrower and AAA is for a high category borrower. Now linking it to the overall theme of the conference, opportunities and challenges. We have also heard it yesterday when Dr. Madhuvich talked about this particular thing, that banks are increasingly facing a lot of risk because of liberalization and globalization. The competition has increased. Now banks have to have their position in the market, so they have to be really doing well. They have to choose the right kind of borrowers and they have to have their clients. And then the innovative products that are introduced in the markets have posed new kinds of risk on the financial sector, like we have the collateralized debt obligations and the mortgage-backed securities. Another thing for having credit risk management is in place is because of the Basel II norms that ask banks to have a credit rating model in place for them. An internal model means that banks are making the model themselves. They are not getting it made through S&P or Moody's or other agencies. Uses of credit rating. The use of credit rating is the decision whether to lend to the borrower or not to lend to a particular borrower. Frequency of renewal and monitoring. For example, if a borrower is not regarded as a AA borrower or has a B category, then there will be more monitoring of that particular borrower. Another is pricing. A higher interest rate will be charged from a low category borrower. Risk mitigants means the collaterals. If the borrower is regarded as a poor borrower, then more collaterals will be asked for. And the last one is level of decision making. So if the borrower is not adjudged as a good borrower, then decision making will be taking more time. The objective of my paper is to develop a working model of credit risk rating. The sources that I have selected for the model is basically the RBI guidelines, proposals, manuals, websites of companies. Now I come to the scope of my model. This model is specifically designed for large borrowers, especially steel industry, and the range of grading is decided based on comparison with peers of the industry, expectations of lenders and experience of renowned authors. And the model is framed using current economic data. This model is designed for banks, so if there are other stakeholders, they can develop their own model for it. How do I click on this? Mouse. So this is the model that I have made. These are the parameters. A is the objective parameter, and then we have the qualitative parameters or the subjective parameters. Then there are various scores of grading that have been assigned from 0 to 4. So 0 means poor and 4 means excellent. So if you can see in growth in sales, if the growth is 0 or negative, then 0 score is assigned. And if the sales are more than 40%, then full mark, that is 4 is assigned. The grading is dependent on the sample selection and comparison with peers in the industry. Then there are other parameters like growth in operating profit, return on investment, debt equity ratio. current ratio, contingent liability upon net worth, debtors collection. So if debtor collection is taking less time, then full marks are allotted. Then we have product range depending on the diversification of that particular company, leverage, operating leverage and financial leverage, they have been assigned equal weights. Cash flow adequacy, that is also very important from the lender's point of view. Then we have qualitative parameters. The first one is laid down regulatory framework standard. So if there is full compliance, then full marks are allotted, that is 4. And if there is litigation proceedings going on for non-compliance, then 0 marks are allotted. In that way, it has been graded into 4 different categories. The same goes for experience of top management, qualifications of promoters, attitudes and skills of employees, technological competence. This I would take up. If the technology is obsolete, then 0 marks are assigned. If old technology is there but it's still workable, then 1 mark. If the technology is same as peers, then 2. If modern equipments are being adopted, then 3. And if there are exclusive patents available to the company, then full marks are allotted, that is 4. So in this way we have other parameters also, can go through it. So this is another thing. A stands for quantitative parameters. There are 14 parameters that I have taken. For qualitative, I have taken 16 parameters. The maximum marks is multiplied by 4 and this is the total marks. Then this company has been graded on the right side. You can see in the block H, column H. So I have denoted the marks obtained by this particular company, and then the score is being calculated for this particular company. Here we have the credit rating model that you usually see. 50%, you can see the below 50% stands for less safety and above 50% stands for good safety, and the range for the lower, that is 8, and first is higher, because if 0 to 30 is the score, then it will be a loss category. So final gradations are made in between. It is as per the RBI guidelines. So just the last slide, impact of single most crucial factor on rating. Besides these parameters that I have designed, there are some other crucial factors which are going to affect the lender's decisions. For example, if a court case is going on against the company, or if the company has a bad track record, if the creditors have requested for winding up of the company, in that case it has to be given top importance. Thank you all of you.
Have you tested this model?
Sir, I have used Prakash Steel as a company, and I have...
But this model is for the banking sector. You are, proposing the model for the banking sector.
Yes.
And you are testing it in Prakash industry.
Yes, sir.
Then how?
Sir, actually I went to Punjab National Bank and they asked me to make a model of myself and give them suggestions. So it has not been validated so much. It will take more time, and then more and more parameters should be added in the course of time. So that is also.
And how the weightage is given, like if the sales are growing at 40%, then 4, and from where you have taken this?
I have taken a sample of industries, and then I have decided, keeping in mind I have read
maximum growth is maximum 40%.
Yes, sir.
Huh? This
so
is the maximum growth.
40% and above.
This is the maximum growth which can take place.
For that I have given 4 marks.
No, the best thing would be that you, developing the model for the banking sector. So keep in mind the growth parameters and other things of the banking sector only, and test it in a particular bank, whether private or public sector bank, whatever it is. That would make the model more consistent.
Yes.
Any question, please? Please.
Good afternoon, ma'am. Ma'am, my question is that what you are talking about is the model which is applicable for industries, right? When we discuss about the banking sector, there are business loans, working capital loans, which are provided on the basis of the credit ratings, and agencies are actually kept in loop, like Satyam, Sibyl, Crisil, they are all helping them out to understand what exactly is the level of credit worthiness of this company. Now, what if the company's credit worthiness is not up to the mark and they switch over from one company to another company name? Like companies are actually getting into multiple companies just to avoid sale tax, because in case the turnover exceeds 2 crore in one company, they switch over to next company and then again third company, fourth company, fifth company, and so on and so forth. Around 50 more or companies under one umbrella only. They are all dealing in under the same roof, but 50 odd companies. If one company's creditworthiness is affected, how can it be affecting the other company's goodwill?
Sir, as you see the model, in the model I have included a term on diversion of funds, whether the funds are borrowed for the short term and they are applied for long term purposes, or whether they are diverted into other business of the same company group. So that is also being taken into account, the diversion of funds. You are taking money for one company and then you are taking this money and you are giving it to other companies.
But what they are doing is actually they are just diversifying their sales. They are transferring their sales from one company to another company. First sale will be in A company, second sale will be in the another company, third sale will be in third company.
You're talking about transfer pricing?
No, then not transfer pricing. Just a manipulation of the accounts, you can call it.
So that they will take into account through that diversion of funds.
I mean, this is evolving model, and she has to keep in mind the so many other parameter. This is just a proposed model, and she has to look into other different qualitative and quantitative parameter, I think. Huh?
Thank you.
This is not the final model. You have
Yes,
to
sir,
test
it
it, and
is still evolving.
it is
Yeah.
still going on in your mind.
Yeah.
Thank you very much.
Actually, you are talking in terms of balance sheet, and he is talking in terms of profit and loss. He is talking in terms of sales. You are talking in terms of liabilities, sources of funds. They have raised and they have given as loan or to subsidiaries and other companies. He is talking about sales. Company is making sales with the name of so many companies. The same company is making sales. कभी कभी दुकान पे जाते हैं हम ये परचेज किया किस बिल बुक में से बिल काटना है वो सोचते हैं फिर बताते हैं because due to taxes etc. So it may happen sometime.
So the solution with the like the bankers is to have personal meetings with the companies, and they have to go to the ground and they have to check. That is the only.
No, it doesn't matter if they go personally and they look after, but the paper formalities have to be there. So if we are directing our sale, we cannot perform, we cannot fulfill the paper formalities also. If we are not billing from the same company, how can we show that we have sold so much of goods during the last year? We cannot show. That is not related to your topic.
Just for the, information of the student, I would like to share something. How credit ratings are important. The rating of the debts specifically. 2 years back, I invested 50,000 rupees in fixed deposit scheme of Unitech. The interest rate offered was at that time, I think 12% or 11.5%. That was the highest available, I think, interest rate. Without understanding and without knowing the rating of the debt, I invested the money. Now after 1 year, I failed to get my principal back. Only I was able to get the interest. And they asked me to renew the FD, and I renewed it now. So problem is that this is the importance of the rating of a particular debt. In India, these things are not very popular, and we tend to ignore them, only thinking that a high rate of interest is offered. If rating is low, then definitely the company would like to offer high interest rate. If slightly the interest rate is low but rating is high, at least we are secure that we will get back interest as well as the principal amount. So therefore the rating becomes very important, and these can only be rated by the professional like ICRA, CRISIL and FitG and other so many other rating agencies are there. So thank you very much, Namita Jain.
Ma'am, I have a
Please.
sir question.
Regarding credit rating agency, layman doesn't understand about the credit rating agency and all.